Today, we're diving into one of the most talked about topics in California real estate, where not to buy a home in 2025. We all know California has a lot going for it. Gorgeous beaches, sunny weather, world-class food, and a vibe that's hard to beat. But when it comes to investing in property, not every part of the Golden State shines. In fact, some cities that look great on paper can turn into serious headaches for homebuyers or investors once you dig into the numbers. So in this video, we're breaking down 8 California cities that real estate experts warn you should think twice about before buying in 2025. We'll talk crime rates, job markets, affordability, and long-term value, all with the goal of helping you make smarter decisions with your money. All right, let's get into it, and don't forget to subscribe. Stockton. First up, we've got Stockton, located in California's Central Valley. On the surface, it looks like a city that's trying to make a comeback. And to be fair, there have been efforts to revitalize downtown and attract new businesses. But here's the problem. Stockton still struggles with high crime and economic instability. According to South Bay Moving Systems, crime in Stockton is a staggering 81.5% higher than the national average and 65% higher than the rest of California. That's huge. Now, yes, prices can be cheaper than in the Bay Area or Los Angeles, but that low entry price comes with high risk. The real estate market in Stockton has been notoriously volatile, meaning prices rise fast and fall even faster. If you're thinking about long-term investment, you could be looking at a very bumpy ride. It's kind of like betting on a long shot at the Kentucky Derby. You might get lucky, but odds are it'll just be a rough race. Bakersfield. Next, let's move down south to Bakersfield, located near the southern end of the San Joaquin Valley. Bakersfield is often seen as one of California's most affordable big cities. Over 400,000 people live there, and housing prices are way lower than in LA or San Diego. Sounds great, right? Well, not so fast. While the cost of living is low, the economy heavily depends on oil and agriculture, two industries that are extremely sensitive to market swings. When oil prices crash or droughts hit, Bakersfield feels it immediately. That kind of volatility can directly affect property values and job security. On top of that, the city has faced environmental issues and limited cultural and recreational options, which makes it less appealing for younger professionals or families looking for a lifestyle upgrade. So yeah, homes might be cheap, but that cheap comes with a reason. If you invest here, expect the ride to feel more like a roller coaster than a smooth climb. Modesto. Modesto sits right in the Central Valley, about 68 miles from Sacramento. It's known for being budget-friendly. Housing costs here are 84% lower than the California average, and goods and services are around 30% cheaper than in most parts of the state. But as with many things that sound too good to be true, there's a catch. Modesto struggles with high crime rates and limited job opportunities. Neighborhood Scout reports that Modesto has one of the highest crime rates in the nation, with a 1 in 30 chance of becoming a victim of violent or property crime. And while affordability might attract buyers, the economic growth here has been slow. Without new industries or infrastructure, property values risk staying flat for years. So even though you might get a bargain up front, your investment may not appreciate much, or at all. As one agent put it, buying here can feel like watching paint dry, except without the exciting outcome. Fresno. Let's move on to Fresno, another major Central Valley city that often gets overlooked by coastal Californians. Fresno is famous for its agriculture. Everything from grapes and almonds to citrus and tomatoes. The area feeds much of the country, and it's got a down-to-earth, community-focused vibe. But if you're looking at it from a real estate investment perspective, things get a little tricky. Even though Fresno is one of California's largest cities, it has high unemployment and a shortage of high-paying jobs. That creates a shaky foundation for housing demand and appreciation. The housing market in Fresno has also been inconsistent, bouncing between short-term booms and long slumps. So while it might look like a place on the rise, experts say its long-term growth potential is uncertain. Investing here could feel like swimming against the tide. A lot of effort for not much return. San Bernardino. All right, let's zero in on San Bernardino. Located in Southern California's Inland Empire region, It's often touted as one of the affordable alternatives to Los Angeles or Orange County. But before you happily click offer, there are a number of red flags every buyer or investor needs to understand. According to official county data, the median sale price for existing single-family homes in San Bernardino County rose from around $460,000 in January 2024 to approximately $505,000 in January 2025, a 10% year-over-year increase, outpacing the statewide 6% growth during that period. Elsewhere reports a typical home value in the city of San Bernardino of around $484,119 as of September 2025, representing about a 1.0% decline year over year. And Redfin data shows the median sale price hitting approximately $513,000 in September 2025, up about 4.1% from the prior year, with the average price per square foot at roughly $356. What this tells us, yes, values are up compared to a few years back, but the market is showing signs of deceleration and softening. Homes are also spending longer on the market. The Redfin metric shows median days on market jumped to 68 days from 33 days year over year. San Bernardino is attractive at first glance, more affordable than many coastal cities, good proximity to jobs in the Inland Empire and some parts of Los Angeles. But the deeper story carries several warning signs. The city filed for bankruptcy in 2012 due to severe financial difficulties and a cash shortage. This legacy still factors into the city's budget, services, and investment climate, as referenced in your earlier list. Inventory and demand are shifting. One real estate market commentary noted that pending sales in some parts of San Bernardino County are down substantially compared to pre-pandemic averages, while mortgage rates jumping into the 6 to 7% range have squeezed buyers' purchasing power. Building permits and new housing growth are also under pressure. While the county's housing market shows some resilience, slower development can imply slower growth. For example, permit rates and inventory data suggest less new housing stock being added than in the boom years. The school system struggles and crime remains high. There's a 1 in 23 chance of becoming a victim of a violent crime. It's a place with potential, sure, but also with deep structural issues that make it a risky bet for property buyers. So if you're not ready for some heavy stress, San Bernardino might be one to cross off your list. Santa Monica. Santa Monica, a highly desirable coastal city in Los Angeles County, is often seen as lifestyle gold, beaches, dining, luxury amenities, but from a real estate investment perspective in 2025, it raises serious affordability and value concerns. According to Redfin, as of September 2025, the median sale price in Santa Monica was approximately $1,934,250, representing an 18.7% year-over-year increase. Another data point from Zillow shows the typical home value at $1,645,445, down 2.9% over the past year. The median sale price reported at around $1.6 million. A Property Focus report lists the median single-family home price at approximately $1,875,000 in a 12-month trend, 2025, for Santa Monica. Rent data compound this. Santa Monica ranks second most expensive in the LA metro for one-bedroom apartments, with median rents at $2,900 per month and near full occupancy of 95 to 96% in mid-2025. What does this mean for someone looking to buy? Firstly, the entry cost is extremely high. Even floor homes in the city sell for well over $1 million. The high rental rates suggest strong demand, but that doesn't guarantee capital growth or investment return. The median home values show conflicting signals. One source up nearly 19% year over year, another showing a slight drop. This can indicate volatility in high-end markets and sensitivity to broader economic factors such as interest rates or local risk, e.g., coastal exposure, zoning. Additionally, when the cost of entry is this high, your ability to realize meaningful upside becomes constrained. There is less value catch-up potential and more risk that the market is already priced for premium quality and location. If you're buying in Santa Monica with an investment or value growth mindset, you're paying for lifestyle more than value, which is not always the best angle for a property investment. In short, Santa Monica shines for quality of life, but as a value investment city in 2025, it poses major affordability barriers and less margin for growth relative to cost. Berkeley. Berkeley, in Alameda County and part of the East Bay market, is similarly high cost and competitive. Recent data show a median sale price of around $1,599,500 in September 2025, up 10.3% from the previous year. Another source puts the median home price in February 2025 at $1,480,000, up approximately 14.1% year over year. The market is also very fast-moving, with homes selling after an average of 15 days. What's important to note for investors or first-time buyers, although prices are high, growth potential is arguably constrained and affordability is increasingly difficult. A City Commission report noted that by 2023, the income needed to afford a median single-family home in Berkeley was roughly $314,000 annually. Yet the median household income for homeowners was around $170,000. These numbers indicate a strong affordability gap. Many working households in Berkeley, nurses, teachers, firefighters, may be priced out of ownership entirely. The high purchase costs, combined with limited inventory and strong competition, often cash buyers, makes it a challenging market from a value investment perspective. Also, Berkeley's market characteristics are unique, motivated by academic town demand due to University of California, Berkeley, affluent buyers, and limited supply. That means although values are high and rising, the ability for typical buyers or investors to enter at an underpriced segment and get meaningful upside is limited. For example, some neighborhoods see dramatic bidding wars. A mid-century modern home sold for $1.6 million, over 100% above asking price. In conclusion, Berkeley offers strong cachet and demand. But for someone looking for a real estate investment with value and growth in mind, it represents a high-risk purchase, high cost, limited margin, and steep competition. San Mateo. San Mateo, in the heart of the peninsula and one of California's most expensive markets, stands out for its extreme affordability challenge. A February 2025 report by the California Association of Realtors shows that San Mateo County was the only county in the state where a buyer needs a qualifying minimum annual income above $500,000, $513,200, to afford a median-priced home of about $2 million. More recently, Redfin data for September 2025 indicate a median sale price in San Mateo City of approximately $1,535,000, though this represents a negative 3.1% year-over-year drop. Even with a slight dip, the entry cost remains dramatically high, and only approximately 17% of buyers in this market could afford the median home. So what are the implications? First, the sheer cost threshold means that even affluent buyers may find limited value upside because much of the market is already priced for premium attributes: top schools, Bay Area job proximity, elite neighborhoods. When your entry cost is over $1.5 million, or closer to $2 million, the affordability cushion that often exists in more modest markets evaporates. Second, although prices may slightly dip or stagnate, the affordability barrier remains durable, making it a market where owning is realistically only for high-income households. For investors seeking market segments with growth from discount or value entry points, San Mateo offers limited opportunity. Finally, given the proximity to Silicon Valley and the tech economy's sensitivity to broader cycles, there may be higher exposure to job market risk, interest rate risk, and speculative demand. In short, San Mateo remains a top-tier, high-cost market with minimal accessibility and limited upside for buyers seeking value. They're buying for location and prestige more than investment potential. So there you have it. 8 California cities that, despite their appeal, may not be the best places to buy a home in 2025. These cities aren't bad places to live. They all have incredible culture, scenery, and energy. But from a real estate investment perspective, they come with red flags that are worth understanding. California's housing market is in a weird spot right now. As of late 2025, the average home value across the state sits around $786,000, according to Zillow, roughly 70% higher than the national average. That's a massive premium. Mortgage rates have also climbed to roughly 6.8%, which means even if prices flatten out, monthly payments are still straining budgets for average buyers. The truth is, California's housing market is one of the most complex in the country. You've got high demand, limited supply, environmental pressures, and huge regional differences. If you're serious about buying property here, remember, it's not just about finding a low price. It's about finding value and growth potential. And sometimes the best investment you can make is the one you don't make. Don't just look for cheap homes. Look for strong fundamentals. That means stable job markets, manageable prices relative to income, low crime, and ongoing development. Real estate isn't about timing the market. It's about understanding what drives long-term value. And in California, those fundamentals vary dramatically from city to city. If you're still set on buying in the Golden State, explore emerging or overlooked counties. Places like Lassen, Lake, Trinity, or Tulare, where median home prices are under $400,000 and communities are growing steadily without the intense competition or volatility of the coast. And most importantly, run the numbers before you fall in love with a listing. A beautiful view won't help if you're over-leveraged or can't find renters to cover your costs. If you found this breakdown helpful, make sure to hit that like button, drop a comment below telling me which California city surprised you the most, and subscribe for more deep dives into housing markets across the U.S. Thanks for watching, and see you in the next one.